Hello and welcome to BQ Prime. India's economy remained resilient in the first quarter of FY24, with GDP growth coming in line with expectations. GDP grew 7.8% in April-June quarter. That's a step up from 6.1% in the January-March quarter. It's also the highest in the last 4 quarters. Now, to share his early thoughts on today's release, we're joined by Rahul Bajoria, Chief Economist at Barclays. Rahul, thank you so much for taking time out.
Thank you, Pallavi. Pleasure to be here.
So, what are your immediate thoughts looking at the figures? Is it broadly in line with your expectations?
Yeah, so the headline numbers are broadly in line with what we were expecting, 7.8% print. It is, a bit of a boost is there from a statistical perspective in the sense that this perhaps is the last quarter where, the lingering after effects of COVID were still kind of showing up, from a recovery standpoint. But I think the biggest takeaway, and we can get into the details, is that services remains the linchpin on which the entire growth recovery is kind of centered. Obviously, the high contact services did show a lot of recovery, but I think the direction of how say primary, industrial, and tertiary sectors have evolved really kind of signal where growth is going to come from and where the policy focus will be to kind of ensure that there is not any material loss of momentum.
All right. So, delving a little bit more into industry trends, services, like you said, continue to show recovery and led growth in Q1 as well. Agriculture, however, was a little bit lower than it was in the last quarter, and that was, I guess, in line with expectations because of erratic rainfall. Now, just a little while before the GDP figures were published, the IMD held a press conference where they said that they expect the southwest monsoons to be normal for the month of September. However, on an aggregate for the full season, it's likely that we will still see the southwest monsoons come in a little bit below normal. So, what's the trajectory going forward?
So I think a small deficit of say about 7 to 8% does not really make a big impact. I think this has been the takeaway even for the RBI, which in its recent research showed that if you have better irrigation facilities, that tends to sort of mitigate some of the effects of a weaker monsoon cycle. Sowing activity as well, particularly for say crops like rice, has been pretty okay. So while September typically tends to be the end of the monsoon cycle, so we get about 17-18% of overall rainfall. So it's still important, but the relatively weak monsoon cycle in the month of August probably is going to still be far more critical. I think what is likely though is that we probably see the Kharif cycle kind of going through relatively smoothly. The implications of say a good or even a bad month of September will be more on water reservoir levels, which can have a bigger implication on the Rabi crop cycle, right, which tends to be less rain fed and more dependent on the standing water which is available in dams. And so I think it will have bigger implications for what happens on agriculture growth, which at the moment even at 3.5% remains very healthy, right? I think that's a pretty decent number in the context of that we have had a string of very reasonably high prints on real agriculture growth. But I think the real risk really is with the next 6 to 12 months when El Nino basically intensifies and the impact that has both on our water storage and on overall rainfall is what will probably have a bigger impact on agriculture activity going forward.
All right. So, before we move into other parts of today's release, I do want to ask you one more question related to the Agri GVA. So, we have seen mixed trends coming in from the rural sector so far. What's the outlook going forward, and what are current indicators looking like? Like, for instance, private consumption today does appear to be a fairly healthy figure, which looks like it's got support from both urban and the rural sectors. But taking into account a volatile monsoon and the fact, like we discussed, that monsoons will be a little bit below normal for the full season, possibly. What's rural demand looking like?
So I think, broadly speaking, rural demand continues to lag urban demand as far as the driver of growth. But it is not to say that rural demand is particularly weak. I think incrementally speaking, we have seen some of the high frequency data kind of perk up at the margin. Whether we sort of look at tractor sales, we look at some of the Manrega related jobs demand, etc. But at the same time, what is also clearly sort of showing up is that the impact of say the relative moderation in construction activity, right? Construction was expected to be a lot stronger than what we really see, so maybe the extent of recovery is not that been strong, and so it still remains an area where perhaps a little bit more policy support will be needed. Now one thing in a pre-election year that we typically tend to see is that governments both at the central and at the state level typically tend to spend. They ensure that their budgetary spending targets are kind of met. So we might see incrementally a little bit more, a bounce or at least some degree of perkiness in the activity levels in the rural areas. But still, I think that relative differential between where urban growth is and where rural growth is likely to persist for a little bit longer.
All right. And what's your take on manufacturing? So, manufacturing expanded pretty much along the same lines that we saw in the previous quarter. It expanded 4.7% in Q1 as against 4.5% in the last quarter of the last fiscal. Is that in line with your expectations?
It's slightly below what we were expecting, but I think the most interesting thing about the manufacturing data really is the divergence between exports and manufacturing itself. So I think what really is coming across are two key points, right? First of all, domestic consumption perhaps has become a bigger driver of manufacturing growth, and this shows up in auto sales. It shows up in perhaps some of the fast-moving consumer good items, and so that clearly is visible that domestic consumer dominates manufacturing demand than what was the trend perhaps last year when exports were very strong. The second factor, which perhaps is keeping manufacturing relatively well supported, is the fact that there's been an improvement in profit margins, right? So after last year, when we saw input costs go up quite dramatically and output prices perhaps were not increasing, this year effectively there's been a reversal of that entire trend where margins have widened. And so, the GVA, which is partly a reflection of profitability, is also kind of reflecting that manufacturing growth. And this also shows up in the mining and quarrying indicator as well, which is a lot stronger than what the nominal growth numbers are indicating, right? And that probably is more a reflection of the fact that WPI inflation was quite low, hence profitability by definition was high. And so I think this kind of a rough trend is likely to continue. Maybe it weakens at the margin, depending on the inventory cycle, but we don't think manufacturing will show particularly any significant amount of weakness as much as what we are seeing in exports.
All right. And going forward, can we also expect a little bit of a bump up in manufacturing? Early festive demands do appear to indicate so.
So it tends to be seasonal, right? So it's a bit hard to say as to what extent do we see that bump up. I think what is perhaps fair to say is that if you look at the July core sector data, right, which came out today, which is clearly very strong, showing reasonably strong momentum in areas around construction. It also, the early indicators for the month of August shows that electricity production, coal demand, etc., are looking quite strong. So I think there will be parts of the manufacturing and the intermediate goods ecosystem which will show fairly strong growth. The question is how much of that shows up basically through inventory buildup. We could have reasonable amount of growth, but then it may not necessarily be enough to keep growth, GDP growth in the 7% headline. I think some moderation will still happen despite there being reasonable sequential momentum.
All right. So, like you said, some sequential easing is expected going forward. In your pre-GDP note as well, you said that in Q1 you expect services recovery to kind of be complete in Q1. So, going forward, uh, what's the outlook on services? Is that expected to drive growth to a lesser extent than we've seen it do in the last few quarters as the economy opened up?
So I think the activity levels are going to remain high, right? But then in several areas, we are starting to hit capacity issues, where you don't necessarily have the ability to grow demand very significantly from here on. And let me give you a couple of examples. So if you look at, say, aviation traffic, right? Passenger traffic basically is already around 430, 440,000 passengers a day, and it cannot go materially higher than that. And so while activity levels can remain high, you will see a pullback in the rate of growth. So what we are looking for is effectively a decline in rate of growth, but the levels of activity, right? And so hence the output gap is likely to remain reasonably closed. Now the question then becomes, with high capacity utilization, do you do see investment levels starting to pick up? And I think there are some signs, right? Latent underlying investment growth has been reasonably strong, and there is a clear sign that it is still continuing to grow slightly faster than the headline GDP growth. So I think we will look for that slight outperformance of investment to basically, say that, okay, over time that capacity builds up and, you are able to sustain relatively higher levels of GDP growth. But at least in the next 3 to 6 months, I think we will come back, in the six handle as far as GDP growth is concerned. But that is broadly baked into, the GDP forecast that the policymakers have at the moment.
All right. So, private consumption, would be fair to say, has grown at a healthy 6%. That's a fair step up from what we saw in the last quarter when there were concerns about weaker private consumption. Currently, and I know this is considered to be largely transitory and driven by food prices, but currently, to some extent, inflation has weighed a little bit on private demand. So, what do you think private demand is going to shape up to be like for the rest of the year?
So, Pallavi, if you take a slightly longer view of this, we have had inflation around 6% for the last 3 years, right? I think it's a fair thing to say that, yes, it has had an impact on the way private consumption has shaped up. But what has also simultaneously happened is that, you are seeing persistently reasonable amounts of growth in consumption, right? And the levels of activity have improved both because of, as a post-pandemic recovery, and then you're also seeing reasonable amount of discretionary spending being there in the system, which effectively tells you that there is an element of high nominal spending as well, right? And so while inflation kind of reduces the level of real spending growth that we see, but the nominal spending levels continue to remain reasonably elevated. And I guess, if we take a slightly longer view of, that income growth in India does look like it's likely to be on a reasonably strong footing, particularly on the urban areas, right? And there are a variety of factors supporting this particular dynamic. I think expecting a growth rate around 6 to 7%, right? And again, expecting domestic demand to kind of anchor growth along with private investment. I think private consumption also, particularly led by urban services, is what is going to really keep growth in that six handle, over the next few quarters. The real question is, can we actually take a step up? And I think in the near term, with there being immense focus on inflation, it is unlikely that you will see any material policy support, right? Whether monetary or fiscal in nature. So I think we can expect private consumption to remain reasonably resilient. But again, the rate of growth might kind of moderate at the margin because, there's only so much the people are going to consume. Yeah.
All right. And was government expenditure a little bit of a surprise? It's come in a little bit negative. It's minus 0.7%. What are you making of that, especially because the government has front-loaded expenditure in Q1?
So I think there could be a bit of a measurement issue in terms of what kind of spending has taken place, because often, if you remember, in 2021 and to an extent in 2022, there were also these impact created by the subsidies, or the lack of subsidies in certain areas, which meant that the nature of government spending, even if the government is spending a lot, it doesn't show up in consumption because it's effectively transfers of capital spending, right? So I think one can see that the capital outlays have continued to remain reasonably strong, both at the state level and at the central level. And so maybe revenue expenditure, where the government has generally been cautious in kind of trying to front load a lot, has something that might have kind of weighed on consumption side, because a lot of the government consumption is a reflection of revenue spending, not necessarily the capital spending part. Still, I do feel that over the next few quarters, we will see the government spending numbers perhaps underperform what the overall GDP growth number will be. But then, cumulatively speaking, the fiscal impulse is not going to remain negative, in a pre-election year, and that's partly given the front-loaded nature of spending that we are seeing from both the states. It will eventually play catch up as far as GDP data is also concerned.
All right. So, after today's figures, will you retain your forecast for the full fiscal? What are the possible headwinds or the upsides that we're looking at for the rest of the year? Also, what are high frequency indicators looking like for Q2?
So I would say we are at 6.3%. We have been at that particular forecast since March of this year, and we remain reasonably comfortable. I would say maybe there's a modest upside, so the RBI at 6.5 perhaps could be a little bit more accurate, but then, you never know how these 15, 20 basis points play out. So we are comfortable with our projections. But I think one thing that's worthwhile mentioning is that even for the second quarter of the fiscal, as you asked, it's a bit of a mixed bag because there are signs that at least say credit demand is something we didn't really speak about much, is showing some signs of tapering, mainly because I think we are in a period where typically demand tends to fall off, right? I mean, agriculture credit is what kind of drives growth at the margin. But then because of a fairly dry August, some of the mobility indicators, which were quite weak in July, have started to become look quite strong. So petroleum consumption, electricity consumption, they are looking quite good. I think underlying impulse of growth is quite strong. We are, as of now, expecting a print which will, as a forecast, is below 6%. But I wouldn't be surprised if we get a print close to 6%, depending on how the rest of the quarter shapes up. I think the overall message we are giving to our clients is that the underlying momentum in the economy still remains pretty strong, right? And so don't expect any particular need for policy support to be there, at least in the next 3 to 6 months, till the time we see material signs of growth weakening, which is not there either globally or within the domestic economy. The overall growth numbers are going to continue to outperform the rest of emerging markets and also at a global level, right? I mean, the overall momentum appears strong enough to kind of keep the fastest growing major economy tag for India for a reasonable period.
All right. So, talking about credit demand, do you also think it's partly the effect of tighter monetary conditions beginning to show up in bank credit growth?
So it definitely is. I mean, we have seen there being an increase, in terms of the transmission and the fact that liquidity conditions have incrementally been tightened, right? I mean, not just in the month of August when the incremental CRR was introduced, but banks themselves have been holding on more liquidity. I think where we see the biggest impact perhaps is more in areas like mortgages, etc., which have been strong for a while. But beyond a point, interest rates being this high does have an impact in terms of consumers kind of delaying large purchases. But it still remains in a reasonably healthy level where the multiplier to say the nominal GDP is probably the same as last year. But because nominal GDP itself has come off, you will see credit growth come off as well. And so some of it is just a reflection of the fact that we are just growing at a slower pace in nominal terms, so that will mean that other monetary aggregates are going to adjust lower in sync with it.
All right. While we will see lower economic growth in the coming quarters, economic momentum remains intact. That's the takeaway with this conversation from Rahul Bajoria. Thank you so much for tuning in. Rahul, thank you so much for taking time out.
Always a pleasure.